first question is what is the blockchain? The blockchain is a distributed information storage technology. It is a public record of a chain of transactions that is protected from hacks and exploits by a cryptographic consensus mechanism. Blockchain technology allows for the creation of an immutable time-stamped record and therefore promotes transparency and accountability by making trust a non-issue. So now we circle around to the question of how money actually comes about in the first place. There's two different visions of that. One is of money as an evolutionary outcome, and the other is as it envisions it as a policy-driven outcome, something that was created by design. Menger takes the position that money is not an invention of the state. It's not the product of an act, a legislative act. Even the sanction of political authority is not necessary for its existence. Certain commodities came about to be money quite naturally as the result of economic relationships that were independent of the power of the state. One of Carl Menger's main contributions to economic thought was the explanation of how an institution such as money could come about as an unintended product of human action rather than a conscious result of human design. Menger's story of the origin of money is evolutionary. It starts in barter and ends with a good or commodity being selected as money for properties that make it particularly suited to be a medium of exchange. The various goods in history have emerged spontaneously as money: salt, seashells, tally sticks, gold and silver, and cigarettes, just to name a few. And the other model of money that we've lived with since roughly the end of the 19th century, so at the beginning of the 1900s, we lived under the model of money as a centrally controlled, policy-driven, technocratic order, in a sense, right? And the transition from an evolutionary form of money to a policy-driven form of money occurred around the time that the demonetization of gold was undertaken. And that resulted in experts being put in charge of making decisions regarding money, this important social institution, and with huge consequences for getting it right or wrong. This centralization process began roughly before World War I and was completed in 1971 when Nixon closed the gold window and removed the last link the dollar had to gold. One argument for having top-down control over money is that in times of crisis, the central bank can act as a lender of last resort and potentially stave off a credit contraction. But the risk of this approach is that you end up tinkering with something you don't fully understand, potentially resulting in adverse, unintended consequences. It is owing to the problem of policy-driven, unintended consequences that Ludwig von Mises claimed stabilization is chaos. He had seen that attempts to stabilize the price level often sowed the seeds for future speculative bubbles. Inevitably, the credit-driven boom gives way to a deflationary contraction, the very thing that stabilization policy and central planning was thought to prevent. Clearly, central management has not produced stability. As you can see in the shaded regions, there's been quite a few recessions since money was turned into a policy tool. Basically, you say 1971 is the beginning of it formally, even though there was roots of this going back to 1913. But as you can see, there's been a cluster of crises. I mean, you don't really have a lot of stability here. It's just hopping from every few years. There's a new correction, a new crisis that needs to be solved. In the fiat monetary system, fractional reserve banking allows for the excessive growth of excessive creation of money and credit, which fuels unsustainable patterns of growth and investment. Policy steers the newly created credit into particular markets, such as residential mortgages or college loans. As new money circulates, it distorts prices and sends false signals regarding the actual preferences of consumers. Entrepreneurs adjust their plans in response to these artificial signals, and they therefore create unsustainable patterns of investment and production, which temporarily appear to be genuine growth. This exceptional growth in boom times comes to an end whenever interest rates rise, either owing to inflationary pressures or a change in policy on the part of the monetary authorities. Higher costs reduce the profit margins, and ultimately many new investments are unwound. When these errors cluster, you get a crisis. For this reason, financial and economic fragility is endogenous to our policy-driven monetary system. Bitcoin was created during the 2008 crisis with the hope that it would offer an alternative. It marked the first iteration of blockchain technology as a payment system. Bitcoin has a limited supply. It will never grow beyond 21 million coins. The current supply and growth rate is open and transparent. New coins are created as a reward for the computational work known as mining, which involves verifying and updating securing the blockchain. In other words, an algorithm governs the supply of Bitcoin. One of the facts about Bitcoin is that it's unbacked. It's not redeemable in gold, silver, or anything else. So the question is what gives this asset value? And how is this not just a form of tulipmania? And the answer to that question is that Bitcoin and other examples of blockchain technology provide services that solve real problems in the world. And the value they have is tied to the value of those services. Value is not something objective or tangible. It is not found inside gold, silver, or anything else, or including legal pronouncements. The value we place on something is based on a subjective appraisal of its usefulness. And many people find alternatives to the monetary status quo useful and valuable. The blockchain makes trustless peer-to-peer networks possible, eliminating the need for a third party or centralized authority such as a bank or regulatory authority. One issue with centralized information systems is that they can be hacked, compromised. Equifax is a good example. So using the blockchain to automate the services of banks and credit card companies will ultimately grow our living standards by economizing on scarce resources and releasing them to be used in the production of new goods and services. So now we're going to talk about moral hazard and the fact that there's a value in a blockchain-based monetary system because it lacks moral hazard. Moral hazard being not a good thing. So moral hazard exists when risk is subsidized through implicit or explicit bailout guarantees. It is present in any arrangement where the costs are not borne by the decision maker. Moral hazard can result in diminished economic growth as institutions tend to take greater risks when they can privatize profits and socialize losses. This increased risk-taking leads to a more fragile economy, greater bouts of boom and bust, and economic growth and inequality is affected. Now I'm going to look at some problems with Bitcoin, limitations that it has to overcome. Right now it's difficult to see how Bitcoin could replace the dollar and become the generally accepted medium of exchange because of its extreme price volatility and what that implies for its ability to serve as a unit of account and store of value. The basic question is, how could this asset ever exhibit the same price stability as fiat money? One reason for the volatility problem is that we are very early in the adoption process. Crypto assets are not widely held. The markets they trade in are very thin. This suggests that the volatility that we see could be a function of lack of liquidity. Further adoption will naturally increase liquidity and reduce volatility. Adding market makers in crypto assets would also help to add liquidity. The ultimate point is that we do not know if cryptocurrency would be superior. We do not know if it would be a more stable or if it would help foster sustainable economic growth. If it does not meet the challenges around volatility that we know, these assets will never become widely used as a medium of exchange, and fiat money will maintain its dominance. The great thing about an evolutionary process is that we do not need to know the final outcome. We can experiment and discover the solution as we go along.